Ladies and gentlemen, good day and welcome to Can Fin Homes Limited Q3 FY22 earnings conference call, hosted by Investec Capital Services. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nitesh Jain from Investec Capital Services. Thank you, and over to you, sir.
Thank you, Fajan. Good afternoon, everyone. Welcome to the Q3 FY22 earnings conference call of Can Fin Homes Limited. To discuss the financial performance of Can Fin and to address your queries, we have with us today Mr. Girish Kousgi, the MD and CEO of Can Fin Homes, Mr. Amitabh Chatterjee, Deputy Managing Director, Mr. Prashant Joshi, CFO, and Ms. Shamila, Business Head. I would now like to hand over the call to Mr. Kousgi for his opening comments. Over to you, sir.
Good afternoon to all the investors. We had a good quarter, backed up by last quarter also, which was pretty decent. Outlook is very, very positive. So we are seeing a good trend since last year, third quarter onwards. And quarter 4 of last year was pretty good. Quarter 1 of this year was impacted due to COVID second wave. Market is quite robust. The only thing is we lost about 45 days in first quarter of this year, and therefore it did impact business, which all of you are aware. And quarter 2 we came back very strongly. And quarter 3 also we've done pretty well on most of the parameters. So in terms of market, I think this market is going to be robust for next few years. Real estate as a space has really improved in the revival, and this buoyancy will stay for another 4 to 5 years in our sense. And we are able to get business from across all the geographies, barring 1 or 2. All the segments, whether it is builder or non-builder, and this is across all type of cities. So whether it is metro, whether it is big cities, mid-sized cities, or small cities. In terms of profile, there has been increased demand from salaried. SC&P demand was quite low. After COVID, I think it really went down drastically. Now slowly confidence is coming back. And we are also seeing that the share of self-employed non-professional incrementally is going up, but it is still not back to 30, because ideally at a portfolio level we were at 70-30, and after COVID I think this changed drastically, and now it is slowly coming back. For last quarter, salary was 74% and S&P was 26%. So this 26 was much lower in the earlier quarters. We were able to log all-time high book growth. We showed about 19.5% book growth. In fact, we had a lot of challenge last year, as all of you are aware, because we had a lot of pressure on BT. So that is now come down drastically since last 4 quarters. So last year, quarter 1, quarter 2, and quarter 3. And to a certain extent in quarter 4 of last year, we had a lot of pressure on BT. Now it has come down. Just to give you a sense, BT amount for quarter 3 was about 78 crores. The same number last year first quarter was 3 times higher. So it is now come back to normalized position, or rather it is better than pre-COVID levels. In terms of disbursement, we have grown by 123% YOY. It may not be the right comparison, because obviously last year because of COVID, we couldn't disburse well. Same thing is true with the entire industry. But still, if you look at the book has grown, because whether we do disbursement or not, I think book could by and large would be same, but for the runoffs. So on book we have grown at 19.5%, and we have done all-time high disbursement in quarter 3. And prior to quarter 3, all-time high was quarter 2. And prior to quarter 2, all-time high was quarter 4 of last year. So in last 4 quarters, 3 quarters have been all-time high disbursement in the history ever. So which means with every quarter, we are trying to improve our disbursements. And if you look at the sequential growth, it is not marginal, it is quite substantial growth what we have done. For example, if you look at this quarter we have disbursed 2,472 crores, which is a good sequential growth of 12%. And if you look at last quarter, it was 2,208 crores. And prior to that was quarter one. So because of COVID, there was an impact. So we disbursed 893. And if you look at quarter prior to that, which was quarter four of last year, it was 2,001 crores. So in last 4 quarters, last 3 quarter disbursement is all-time high. And same thing is true with even sanction also. Quarter four of last year was 2,201 crores. And quarter one was low because of COVID. It was 829 crores. Quarter two was 2,288 crores. And quarter three approvals are 2,762 crores. So last year, we did change the pricing strategy because there was a lot of pressure on book, and the book was depleting. BT out was significantly higher, and there was no opportunity outside because of lockdown and COVID, and therefore we had to drop the rates. We did that in last year. That had an impact on margins. And in this year, from April till now, we have increased rate twice, and our yield has improved from 7.99%, which was in quarter two, to 8.05% in quarter three. And now you will see increasing trend. So coming quarter, yield will be higher than 8.05. And if you look at cost of funds, I think it is pretty stable. Quarter three was 5.56. And quarter two was 5.57, and if you look at quarter one, it is 5.6. It's pretty consistent, and here or there, I think 1 or 2 bits there is a difference. Otherwise, it's maintained. Incremental cost of funds for quarter three was 4.98%, and at portfolio was 5.56. So if you look at spread improved from 2.42, which was in quarter two, to 2.49% in quarter three, and quarter one was 2.4. So if you look at NIM was 3.53 last quarter, and this quarter is 3.74, and quarter one was 3.31. So in last 3 quarters, largely if I have to talk about, margins are improving, disbursements are improving with every passing quarter, approvals are improving, book is growing. Now there is a challenge of revenue and PAT. Now the issue is that, last year same time our yields were higher. We dropped price, and that had an impact, for next 3 to 4 quarters because of the lag effect. Now this year we have increased rates, so now margins are improving, our book is growing, disbursements are growing, and this quarter, if I have to look at, let's say 9 months for example, I think that is flat. And revenue, there is a degrowth. Now that is purely because of the lag effect of rate change. Now next quarter, we expect that if you look at whole of this year, vis-a-vis compared to whole of last year, there will be growth in PAT, and the revenue would be flat. Now starting quarter one of next year, then we'll be back to normal state. The impact of rate drop, the impact of rate hike, I think both would have got adjusted to, and from quarter one onwards, you will see the benefits of increase in rates what we did this year. I think that is where we stand in terms of revenue and PAT. In terms of margins, as I mentioned, I think last 3 quarters there is increasing trend both on spread and NIM. NIM for this quarter was 3.74. That also has an effect of investment, because of NCR requirement. If I discount that, our NIM will be 3.65 against NIM of 3.53, which was in quarter two. And even in this quarter, we have to make investments due to NCR, and therefore this 3.65, we will definitely improve on 3.65. But of course, that 9 bits is because of the NCR investment, because our return on investment is much higher than the cost, and therefore this 9 bits got added to that. So this we will see in quarter four also, but not significantly after quarter four. And therefore, I'm saying we should read probably NIM as 3.65 against 3.74 because this 9 bips increase may not be recurring in nature. In terms of asset quality, we were able to improve NPA from 0.78 to 0.71. This quarter, we were able to collect from the NPA pool, write back certain amount, and also we ensured that recent RBI circular, which was announced on November 12th, that didn't have much of impact because we preponed all our collections and we were able to manage collections efficiently, and our collection efficiencies improved. Now actually it is back to or maybe now it is better than pre-COVID levels. I would open the floor for discussion.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The first question is from the line of Shripal Doshi from Equirus. Please go ahead.
Hello, sir. Thank you for giving me the opportunity and congrats on the good set of numbers. So the first question was with respect to credit cost. What caused a sudden increase in the standard asset provisioning that we've done during the quarter?
So basically when we increase our disbursements, my provision would go up because I have to provide on the incremental growth in the book. So if you look at quarter 3, we grew incremental book by over 1,500 crores, and therefore my provisioning to that extent will go up.
But so would that not be the part of the ECL that we do? I mean, ECL provisioning that we sort of calculate.
No, because we look at both ECL and IRAC, but we are holding 240 crores, which is as per the IRAC. We hold higher. We are holding 240 crores, and as per ECL it's about 157 crores. So we are holding 240 crores.
Okay, so which is higher than the required as per the ECL model?
We are holding far higher than what is required. We are holding 240.14 against 156. As per ECL model, provisioning required is 156 crores. As per IRAC, it is 240.
Got it. And sir, how are we seeing the collection efficiency trend? Yes, sorry.
You also asked about credit cost. So credit cost is 0.4. There is no change in credit cost.
For standard asset, you are saying, right?
No, this is overall.
Right.
This is overall. For standard asset, it is 0.45 because of slab change.
Okay.
So this time, why PAT is low is only because of provisioning under SA about 11 crores and 5 crores for NPA bucket movement.
Got it. So, sir, how are we seeing the collection efficiency trends in the restructured pool? Have you seen any slippage from there?
No, actually, restructured pool, out of the sets where it is not due, 20 crores we have closed, which means customers have paid back. So the pause has come down by 20 crores from the restructured pool. And very few accounts were due, and there we have 100% collection. Actually, to be very honest, it's too early to comment on restructured pool because till quarter 3 we had very few accounts where EMIs were due, whether interest or EMIs were due. And in such accounts, we have collected 100%. But outside this pool, where restructuring option is availed, but customers have come forward and closed the loan only. It is not prepayment. It is closure of loan only is about 20 crores.
Okay, got it. So the third question was with respect to the strong disbursement that we've seen. So what is the infrastructure that we are planning to add in terms of the branches and employees going ahead? Because if you look at since March 19, we've broadly added 13 branches. And while I understand that you've been rationalizing branches in terms of relocating and closing some of the inefficient branches, but incrementally, what is the thought process?
So basically, last year we took a call that we will open 6 branches because of COVID and other reasons. And otherwise, on a yearly basis, on a steady state, we would open about 12 to 15 branches. So going forward, you will see branch expansion. Having said that, we were able to grow our book, without increasing too many branches from about 19,000 crores to about 25,000 crores.
Right. So incrementally, we will need to add branches to sort of continue.
Yes.
Got it. Thank you, sir. I'll come in the queue for more questions. Thank you. And good luck for the next quarter.
Thank you.
Thank you. The next question is from the line of Maruk Adajania, individual analyst. Please go ahead.
Good afternoon, sir, and congratulations.
Thank you.
So I had a couple of questions. Firstly, the impact of the LCR has been positive for you, is what you said. How did that happen?
So basically, my cost of funds is 5.5%, and we had to invest in government bonds, which fetches 7%. So they have a positive carry.
Got it. Okay, sir. So, and the other question again is on RBI norms. You did clarify that you did not have impact because you preponed collections and your collection efficiency is improving. But in terms of your upgrade from NPL to standard, were you doing it after receiving all EMIs, or how did that happen earlier? And will there be any follow-on impact from that in your next quarter's asset quality?
From November 12th onwards, any upgradation was based on entire arrears collection as per the new RBI guideline. Okay. Now, all active accounts went through this collection process for 2 months after the RBI circular, which is for the month of November, and second is month of December. So 2 months we have seen all live accounts, have gone through this process, and we are able to manage because we preponed collection, and therefore the impact on this to NPA was negligible. For example, earlier, let's say in a quarter like let's say quarter 3, we had time till 31st of December to collect. Right now, October had 31 days, then November had 30 days, and therefore December 29th only was the cutoff. December 29th was the 90th day for all assignment to collection, so that it doesn't flow to NPA. So we lost 2 days because of this new guideline. So we preponed and we collected all by 29th of December, so that nothing flows to NPA. I think largely our strategy was in terms of arresting the flow, and to a certain extent, wherever we could we could upgrade the account. We collected full arrears and upgraded the account.
Got it, sir. So, and just in terms of rates, so say if your benchmark lending rate were to change today, when will your outstanding or your old loans reprice? After how much lag? Beginning of next quarter, or how does that work? Because if rates rise, we just want to assess the impact on your margins.
See, the entire book will get repriced in 1 year.
In 1 year?
Yeah. Suppose if I want to suppose let's say tomorrow there is change in repo and the rate goes up, and if I want to increase it, I can pass on that in about 15 days time. In the natural course, it takes the entire portfolio will get repriced in 1 year.
Got it. But how much of your loans are repo linked?
All the loans.
All the loans, no? Okay. Got it, sir. Okay, sir. Thank you.
Thank you.
Thank you. The next question is from the line of Utsav Gogirwar from ICICI Prudential Life Insurance. Please go ahead.
Thanks for the opportunity, sir, and congratulations on a good set of numbers. My first question is with respect to the strategy and competitive dynamics. So if we look at our website, the starting rack rate on individual housing is roughly around 8.25%. And the gap between, say, Canfin rack rate and, the lowest lender is roughly around 175 to, 180 basis point. This is a similar gap. 1 year back, it was around 40 basis point, So I just want to understand what has changed in last 1 year in terms of strategy or the way we are doing the business, because of which we are able to charge higher. At the same time, the disbursements are also doing, all-time disbursement we are doing. So I just want to understand on the strategy front. Also, if you can also talk about the competitive dynamics in the current environment, that will be also helpful.
Sure. So basically, what has changed? Nothing has changed. I think we are almost back to pre-COVID time. I think barring Omicron, that is the COVID third wave, I think we are back to pre-COVID times in terms of demand and market dynamics. Now, we had changed the pricing strategy because there was COVID first wave, which impacted the entire economy, and there was national lockdown. And therefore, no business opportunity was not available outside, and therefore there was a lot of pressure on the balance transfer, right? Now, so then for book retention, it was absolutely necessary, for us to be competitive on the yield, and therefore we had to drop the rates to retain customers. When market opened up, when market improved, we increased rates, and which is why we're able to grow our disbursements, grow our book, and still retain the existing customers. I think one big change is that now economic activity is back. We are almost back to pre-COVID levels in terms of demand and economic activity. That's the only change. Because for many years we've been operating at least 150 bps higher than bank rates, bank home loan rates. So I think that is something that we have managed over 3 decades. So now we are back to those times.
Okay, sure. And so my second question is with respect to the cost of funds. Now, if you look at our total borrowing mix, around 15% is CP, and that although it has come down compared to say last 1 or 2 quarters. But in a rising interest rate environment, how do you see the cost of funds movement, especially next year? And what are the levers we are available with us to control the cost of funds?
So basically, we feel that in next couple of quarters, rates will start inching up, but we expect rate to increase by about 100 to 125 bits in next 4 to 6 quarters. That is something that we have budgeted, and we can easily manage that, because we have operated when the rates were high and then the rates dropped. So now again the rates will start inching up. So I think that won't be a challenge at all. Our strategy broadly would remain the same. So we are actually agnostic in terms of source of funds as long as they get the cost increase. So our strategy would remain the same, and we would easily be able to manage increase in rates between 100 to 150 bps.
Sure, sir. All the best. That's it from my side.
Thank you.
Thank you. The next question is from the line of Nitin Jain from Fairview Capital. Please go ahead. Nitin Jain, your line is in talk mode. Please go ahead with your question. Mr. Jain, your line is in talk mode. Please go ahead with your question. As there is no response, I have muted the line. The next question is from the line of Devansh Nigotia from SIMPL. Please go ahead.
Yes, sir. Thanks for the opportunity and congratulations on good disbursement. Sir, last quarter we mentioned that we were going to start initiating legal action and SARFAESI for the NPA pool. So what exactly is our progress there? Because there is a possibility of some reversals in the credit cost there. So if you can just throw some light there.
So in quarter 3, we were able to crack close to 17 crores from NPA pool. So that legal action is on now. So all the SARFAESI initiation, SARFAESI action, all that is on across all the states. So we are able to crack about 17 odd crores. That is why you see that 0.7 it has come down to 0.71. So we were able to crack about 17 odd crores. I think going forward will increase.
So, but then if I adjust the 16 crore credit cost in this quarter, that is after the 50% reversal in this NPA pool of 17 crores, right? If that's the right understanding, because you mentioned that 50% is already provided in this pool, so then how will this interplay?
So it could be 50, it could be 100. So it's from various buckets.
Yeah, regarding that 16 crores what we provided, 11 crores pertain to standard assets and only 5.5 crores pertains to the NPA bucket movement.
So, but the NPA pool that has been sold will also be reversed, right?
Yeah, that's been reversed. Yeah, the total overall, if we calculate on this, overall provision required is 7 crore, overall provision withdrawn is 1.7, so net impact is 5.3.
Okay. And we mentioned the collection efficiency of 100% in the restructured books. So this was for the pool that was due for 3 months or 6 months period that we highlighted in our earlier remarks.
Restructured pool is started from October onwards, so it is too early to analyze the collection position in the restructured pools.
See, because the accounts, very few accounts have fallen due now, and there we have collected 100%. I think beyond this, from the pool where neither interest nor EMI is due, so the pause has come down to 20 crores already.
Okay. Thanks a lot, sir. This is from my side.
And just to give you a number, 20% of customers where EMI has not fallen due, they are actually started paying. So 700 customers out of 4,400 customers, they started paying.
Okay. So restructured book should reduce going forward.
It should reduce because in these 700 accounts where they are paying, neither interest nor EMI is due.
Okay. Thank you.
Thank you. The next question is from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Sir, thanks for taking my question. So first, couple of data keeping questions. If you could just share what was the quantum of borrowings as at the end of December 21?
Borrowings stood at 22,550 crores.
22,550 crores.
Yes.
Yes, sir. And so what were the incremental yields during the quarter?
Incremental yield is 8.02.
So 8.02 incremental, and despite that we're talking about 8.05 portfolio yield.
Yeah, 8.05 is the yield on portfolio, and incremental is 8.02.
8.02 on housing loans.
On housing loans.
We have kept that LCR investment is out. See that 8.02 is on the housing loans, that is the advances. If we consider the LCR investment return what we have earned, it comes to around 6 bits more than that one. It comes around 8.07. So yield of 8.02 is purely on housing loans. Incremental yield we refer to housing loans only, keeping the LCR which is just started now. We kept out of the purview for the purpose of incremental yield calculation.
Okay. So then fair to say that, I mean, instead of a drag on your margins because of this new LCR requirement, you're actually seeing your NIMs and so-called your yields going up because of the implementation of this LCR requirement from December onwards?
See, I'll tell you, I think we cannot comment on how this is going to behave in future because today the yield is higher. So after a few quarters, you never know, yield could be lower. Right? I think only thing is we have to comply with LCR norms and we are complying. At this point in time, there is a cost to carry.
Sure, sir. So the other question that I had is, I mean, I see that in your presentation you have, I think, restated your borrowing mix that you gave during the last quarter. So, I mean, what have you done? If you now raise CPs from bank, do you now classify it under banks or do you now classify it under CPs?
The borrowing from the CP remains CP only. Now, bank borrowings have become more cheaper than the CP because we have to take into consideration both cost as well as ALM factors into mind. So that is why there is a 3% shift to the bank borrowings and CPs have come down by 2% from quarter-on-quarter, sequential basis.
Okay. Okay. So, and maybe the last question from my end before I come back into the question queue. Were there any one-offs in your operating expenses during the quarter, either because of, let's say, CSR expenses or technology spends, or would it be fair to say that your operating expenses during the quarter are a direct reflection of your higher disbursements? Or have you kind of upfronted some of the expenses that you typically book during the fourth quarter of the fiscal year?
No, there is nothing one-off expenditure like that. It is an ongoing, where the AS15 provisioning the company has to provide in respect of all staff expenses. So that has been coming to the effect, which is slightly 1 crore more than what it was there corresponding quarter last sequential quarter. That's why there is a slight up is there as such in the expenses side.
Okay. So if I can squeeze in just one last question here, rather two parts to this question. One is, I mean, why have you had to increase the provision cover on the NPA pool? Is it because these are, I would say, legacy, and because these are legacy NPA loans and because you're not able to resolve them, and because of the aging, you've increased the provision cover on your NPA loans from 40 to 45%? And so lastly, what impact has this Omicron-driven third wave had on your disbursements during the month of January?
So one is that the provisioning for NPA is basically bucket movement, because now after November 12, we had to collect the entire arrears to upgrade the asset, right? So now this 5 crores is only for NPA bucket movement, correct? Now, and the balance, as clarified by Joshi, is for stand assets. Now, Omicron had an impact, even though severity was low. Obviously, the efficiency of our employees was quite less vis-a-vis compared to other months because of Omicron. In terms of business impact, we have not seen much. Okay, so I would say the impact could be hardly some 4 or 5% in the month of January, which we feel we can easily cover up in the next 2 months.
Right, sir. And sir, congratulations on a good quarter, and wish you the very best. Thank you so much.
Thank you.
Thank you. The next question is from the line of Harshvardhan Agrawal from IDFC AMC. Please go ahead.
Hi, sir. Thanks for the opportunity. So one thing I wanted to understand, you said that the incremental yields are at 8.02%, but what I check on your website, the lowest rate mentioned is 8.25. So just wanted to understand why this divergence in the yield?
No, see that wherever the rate of interest, when we do the rate of interest increase, it is having a lag effect of 1 year. The reset will take place over a period of next 1 year. So the 8.25 rate, what we implemented in the Q3, is for the prospective lending, and the existing book will get reset in the next 1 year. So that's what the full impact will come in the next 1 year.
So, but you said the incremental yields are at 8.02. It means the fresh loans that you're giving is at 8.02.
We have discounted off.
Yeah, correct. So the incremental yield is 8.02 because it also depends on the mix of products that we have generated, and we also had offers. So we have a rack rate and we also have an offer.
Okay. So basically,
you must have seen home loan rates at 6.5%, or maybe 6.4%. So we also have an offer. Rates not as low as 6.5, but we also have an offer where the rates are lower than rack rate. That is subject to certain conditions like bureau score of so and stuff like that. But the average yield, incremental yield, is 8.02. So I think if you look at Q3, the yield is 8.02.
Okay, sure. And so one last thing I wanted to understand was on the repricing of the book. So just for my understanding, let's just say if I were to take a loan in January 21, which was at 7.25 rate, so from January 22, is it that my loan would be repriced at 8.25 automatically?
No, it won't. If you have taken under the offer, then it will get back to the rack rate. If you have taken under the rack rate, then your rate will not change.
Sorry, sir, didn't get the last sentence.
So suppose if you have availed the loan at the rack rate, then your rate will not change. If you have availed loan at at a discounted rate, then it will go back to the rack rate. Your rate will change only when I change rates for all. When there is change in the interest rate scenario.
Right. So because what I understand was earlier we were following that automatically when we change rates, after 1 year the back book automatically gets repriced onto that rate. So we have discontinued that working. Is that so?
It depends on the risk rating. Okay, depending on the performance of the account, the rates will get changed. But if you have taken a rack rate, the rate remains. Let's say nothing changes, then your rack rate remains.
Okay. Okay. Sure. Got it. Thanks.
Thank you. The next question is from the line of Ankush Agarwal from Surge Capital. Please go ahead.
Yeah. Hi, sir. Thank you for taking that question. So, sir, again, nitpicking a little bit on this reset of loans. So, our entire book is variable interest rate book rate with resets annually. So, for example, if I take a loan currently in the month of January 21, the reset for my loan will happen in January. Sorry, I took a loan in January 22. It will get reset in January 23. That is the right understanding, right?
Yeah.
Yeah. And in case there is some increased interest rate environment going on, if you want, you can still reprice in the middle, in between this 1 year period. You have that discretion.
Yeah, we can reprice anytime, depending on the market condition.
Yeah. Market condition, right. So similarly, on our borrowing side, how much of our borrowings are like repo linked to repo and are variable?
100%. Because I think barring few loans, I think all the loans are variable. So it's directly, indirectly linked to repo.
Right. So I think bank borrowings, NHB borrowings, those are the majority. I think CP would be fixed, right?
Yeah, correct.
Right. Got it. So more or less, in case the interest rate started rising quite fast, we can reprice our book instantly if we want to.
Yes.
Right. Thank you. And so secondly, what kind of leverage are we looking at, like on the higher end?
I mean, if you saw that last year it was coming down.
Right.
And now because of this rate change, there has been slight change in the PAT numbers and therefore there is slight. So I think we are comfortable up to 8 and we also have planned to raise capital.
So we're looking to raise capital at 8 times, that is what you're saying.
No. Two things. One is we are comfortable up to 8.
Okay.
We are of 8 and we also plan to raise capital. So these are two different.
Right. So you won't look to go above 8. That is what you're saying. Because I think till 2019-18, I think we were above 9.
Correct. Yeah. That's it.
Okay. So why this change in stance, sir?
Sorry, come again?
Why this change in stance when earlier we used to go up to 9 and 8, 10 times leverage, and now we are saying that we won't go above 8. So why this proof?
It was 9. Yeah, earlier it was more, but I think now we have worked out and we want to be around 8. That's what we feel we are comfortable with.
Right.
As per the regulator, I think there's enough scope, but I think to be competitive in the market, even in terms of borrowing, I think all the banks would expect us to be quite low on DR, on the leverage, and therefore we want to keep it around 8ish.
Right. Got it. And so another thing on this cost to income ratio, I mean, it has increased quite a lot this year. I think it's now for this quarter, we have clocked at 19%, right? I think just before COVID and all the years, it was around 15-16%. So what's the reason for this?
So I think one is provisioning.
No, I think our cost to income ratio that we give on the presentation is excluding provisions, right?
No, that there is a AS15 provisioning. We are referring to the provisioning as per accounting standard 15, what you have to provide for.
Okay.
That is to the extent of around 5 crores has been come for this quarter, which is slightly higher compared to the previous quarter, and some more expenses have been slightly increased because volume of business has increased. Because of that, it has been increased by 1.6% compared to the sequential previous quarter.
Right. So in the medium to long term, where do you think this number would settle, sir?
It is somewhere around the 16, 17 is the average range where it is going to be hovering around over a period of time.
16 to 17%.
Yeah.
Right. Okay, so just one last feedback. If on our quarterly presentation, if we can improve a little bit on the disclosure side, for example, like some of the basic metrics like book value and our absolute borrowings are not there in our quarterly presentation. So if you can add that, that would be very helpful going ahead.
Book value and, sorry?
Borrowing. Some of the basic metrics like what is the total debt, what is the book value, those kind of basic stuff is also missing, right?
Sure. Okay, right.
Thanks for the session. We'll incorporate.
Book value, borrowing.
Yeah. Oh,
What we give in the annual reports, we try to incorporate these things so that.
Right. Okay. Thank you. That was very helpful.
Yeah, sure.
Thank you. The next question is from the line of Ashwin Kumar Balasubramanian from HSBC AMC. Please go ahead.
Hello.
Please go ahead.
Yeah.
Please go ahead.
So, on the LCR bit, you mentioned that you had a positive impact. So just wanted to understand what will be the nature of the investments which you will have for LCR, and also what will be the quantum in terms of the investment book that you need to hold for LCR?
Quantum is 600 crores and the nature is GSEC. No, yield what we're getting is about 7, about 6.75 to 7, 6.75 to 7. So I think that is where we have some impact, positive impact on the NIM.
So these will be longer tenor GSEC then, is it? Or,
10 years.
Okay. And 600 crore is the additional for LCR, or it's the total investments on your balance sheet?
It will come in the investments in the balance sheet because this is started from this financial year only from
total. It's total amount, not incremental.
Okay, got it. And also, I mean, if I just noticed in a presentation in terms of lab segment, although the base is small, we've seen a good growth this quarter. So, I mean, is there incrementally more focus on that segment, or what is the strategy there, and what will be the customer segment there for you?
So I think customer segment is same, our policy is same, underwriting standards are same. Only thing is our lab book was very small in the entire portfolio, it is only about 5%. So we thought, we'll double the book in next 3 years. So that 5 will become 10 in next 3 years. So we would maintain 90 home and 10 lab. So because generally within the 10 non-home loan, we have top-up loans. So if I exclude that, pure lab is only 5%. So we thought we should grow that book. We have an opportunity there without compromising on the risk profile of the company. So that's our plan. That is the next 3 years. So you will see lab book growing at a much faster pace than home loan.
Right. And just one more question. In earlier quarters, your rack rate was also a bit lower, and you had changed your strategy in terms of, wanting to sort of be competitive with banks. So currently, given that your rack rate is much higher and your incremental yield is also at 8%, so is there again like a change in strategy of customer segment in terms of the segment which you are catering to versus the segment which banks are catering to? Because even though banks are offering let's say 6.5%, 6.7% kind of rates on home loans.
Yeah, earlier if you see the difference between banks and us, it was about 150 and for certain products 200 bits, 150 to 200 bits. So now the differential is not that much. So now we would be probably 100 bits higher than banks. So to that extent, certain markets have opened up for us, where we see an opportunity of growing our book quite fast. But having said that, I think the starting point for us is to maintain the margins. So we will, I think I mentioned this earlier also. 3 and 2.4 is what we would definitely protect. I know today our NIM is 3.74 and the spread is 2.4, and obviously it will improve. But I think what will protect is 2.4 and 3.
Okay. Thank you.
Thank you. The next question is from the line of Anuj Jain from ValueQuest Capital. Please go ahead.
Hi, sir. Thanks for the opportunity. I have few queries regarding loan book. So, first is, what is our highest exposure to any single real estate project?
Real estate project, see now the total book only is less than 1 crore.
No. I mean to say via home loans, via individual home loans, what is
individual home loans? My maximum exposure would be on an independent property would be about 3 crores.
3 crores.
Sorry?
And what is our highest exposure to any single developer?
Developer is less than 1 crore.
Sorry, let me rephrase my question. My query is, through individual home loans, what is our exposure to any single developer or any single project? Let's say, for example, in any particular tier 2 city, there is 5 different projects of a single developer, and we are financing those through home loans. So do we have any cap on the exposure to any single project like that?
Understood. If you look at a portfolio, 75% is non-builder and 25% is builder. And this 25%, we fund for apartments in a project which is nearing completion. We don't fund at maybe plinth stage or maybe at a 50% or a 60% level. We fund only when the project is nearing completion, and to that extent our completion risk is quite low. And let's say there is a builder and we have funded in 5 projects, and these 3 projects are complete. If 3 projects are complete, I don't carry any risk there because the properties are registered and the building is complete, project is complete, so I don't see any risk there. So that will be out of my exposure bucket. So at any given point in time, at the enterprise level, out of the 25% of incremental sourcing, or maybe if I can take last 1.5 year sourcing, because the kind of projects what we fund would typically get completed in about 12 to 18 months, because we focus on small builders, small projects, not high rise, or maybe Cat A, Cat B kind of developers. So my risk would be always in the range of 7 to 8% in terms of completion.
Understood. And sir, can you also provide a state-wise exposure of our loan book?
State-wise exposure. So we can provide the details to you. For example, earlier Karnataka used to contribute about 30%. So now we are well diversified. Now South contributes to about 67-68% of business. If you want any particular state, we can share that with you.
So within this South, if you can just tell us top 5 states and their contribution.
Well, I didn't get a question.
So within South region, distribution among different states, Karnataka, Tamil Nadu, Maharashtra.
So on an incremental basis, Telangana does about 150 crores. So Karnataka would deliver about 210 to 15 crores. TN would be quite lower, would be about 110, 115 crores. So this is the split in South.
Understood. Okay, thank you. Thanks a lot.
And Telangana would be 70 crores.
Sure.
Thank you.
AP is 70 and Telangana would be 150. So together, erstwhile Andhra Pradesh would do about 150 plus 70, 220.
220. Okay. Thank you, sir.
Thank you. The next question is from the line of Gaurav Kochar from Mirae Asset. Please go ahead.
Hi, good afternoon, sir. So just to understand the margin dynamics and the impact of LCR, so in the numerator, in the net interest income, while the interest income would flow, the interest income on the LCR bit, but in the denominator, would you include investments?
Yeah, we do include investment because it is started only from December onwards. That's why the denominator is smaller, but over a period of time it will be getting passed on average basis. It will be getting added just like housing loans.
Okay. So this 9 basis points you are attributing to is because of lower base of denominator. Hence, then on the numerator there is a full impact of interest income on LCR, and the denominator is slightly small because of lower base. Is that the reason why there is a basis point difference?
Yeah, that's why we are telling that yield excluding the investment yield, it is NIM is sitting at 3.65, and with the LCR investment income it is 3.74. So the difference is 9 basis points. It is only out of that one.
Okay, so sure. So going ahead, you expect this margin actually to the 3.65 structurally, should that improve in the next, say, 1 year or so, that core margin, excluding the impact of LCR?
Yeah, 3.6. I think we should take it as 3.65 because this LCR yield may not be recurring in nature. It will recur, but the quantum will be very less. And therefore, 3.65 is the reference point with previous quarter of 3.53. Yes, this 3.65 has scope to improve.
Okay. And just the second question was on the incremental yields. You mentioned 8.02 on the home loan portfolio. Sir, if our incremental rack rate is 8.25, which is the minimum, and incremental yield is 8.02, so are we giving a discount? I think in one of the questions earlier also you alluded to, but wasn't quite sure. So just wanted your comments on the incremental book that you're disbursing. Is there a discount given there also? And hence the weighted average yield is 8.02.
For a limited period, yes, we do give discount.
Okay, sure. So incrementally, I mean, given this was a festive season, maybe that's why. But going ahead, maybe in 4Q or beyond, the marginal yield should be higher than 8.25. Should we assume that?
I would put it this way. So my yield last quarter was 7.99. This quarter is 8.05. I think this 8.05 will improve quarter on quarter.
Okay. So specific to home loan, that yield has some legs to move up, maybe towards that 8.25 blended basis. 8.25 is.
Home loan, non-home loan, I think both will improve, and yield will, and also whatever rate revision we have done, that portfolio changes would happen, in some time because there is always a lag effect. So yield will improve.
Sure. And so, given the leverage is less than the maybe the threshold that you have just spoken about, and given the ROEs are high and growth is also in mid to high teens, why do you want to raise capital? Just wanted your thoughts, one. And secondly, on the leverage bit, do you see any, because right now also we are getting borrowings at very competitive rates. So do you expect post capital raise the cost of funds or the rating, so to speak, improve?
We will not raise too much of capital, but we feel we need to raise a bit of capital so that our cost also would come down and even the leverage would drop. So we want to raise some capital, not large amount. We have enabling approval of up to 1,000 crores, so we might raise part of that amount, in the next couple of quarters.
Okay, understood. Thank you, sir. All the best.
Thank you.
Thank you. The next question is from the line of Ritika from Ocean Dial. Please go ahead.
Thanks for the opportunity. So firstly, you had touched upon the self-employed segment, which obviously, used to be a higher share. How are we seeing the trends on an incremental basis, and anything that we are looking to, as a strategy to maybe again, gradually increase this pie? That's the first question.
Sure. I think it used to be 30% incrementally earlier. When after COVID started, it came down to about 12% and then increased to 15, 18. Now it's come back to 26%. So I think in another quarter or two it will be back to 30%. We don't want to force fit to increase sourcing from self-employed and change the mix. Because we had challenges of COVID in last 2 years, so we want SENP as a segment to come back naturally, and now it's almost back. So from 30 it went down to 12, then we saw 15, 18, now it's 26. So I think another quarter or two it might be back to 30%.
And sir, any changes that we would have made to our underwriting, get back to these numbers, and or do you think that generally the ground, or rather the business impact had, over the time reduced, and that's how, we were comfortable again going back here, or had we, done something?
We have not made any changes, not only for SENP, even for salary. We have not made any changes because of COVID. We only changed some processes. We only tightened the process because of COVID. And after after first wave in the month of January, we restored all the procedures back, and after that we have not made any changes to the process also. So we don't feel that there is a need or necessity, and that is why we are pretty comfortable whether the SENP share goes down or goes up.
Sure, sir. And the second question is that just firstly, just confirming, did we share that 210 to 215 crore is the incremental, share of, or maybe after 2,000 plus crore disbursement that we do, 210 to 215 came from Karnataka? Did I get that correct?
No, incremental. For example, if we have done 2,472 crores in quarter 3, so every month what we get from Karnataka is around that number. It's not booked, it's only incrementally.
No, understood. So this is a monthly number which you shared.
Exactly, yeah, a monthly number.
Understood, yeah, because that's why I was saying if the share came down very sharply, so I just wanted to check out. Great, so those are my 2 questions. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Mayank Gulgulia from SUD Life. Please go ahead.
Yeah, hi sir. So we have shared like entire loan book will be repriced with a period of 1 year. So and if you want, we can change in between also. So let's say if right now yield says 8%, so it's like 4% repo plus 4% credit spread, and this spread we can change any point of time, and remaining 4% repo rate that will change as and when RBI change the policy. Is it that the way our lending is?
We see whatever incremental sourcing I do, and if I give any offer, that offer will go back to rack rate after 1 year. That's number 1. Number 2, every year we do review all the accounts, and we have a risk categorization S1, S2, S3, and depending on the category, there is a rate which gets loaded to the account. So these 2 things we do. Apart from these 2, if at all there is any change in the interest rate scenario, whether rate goes up or goes down, we pass on that either benefit or that increase to the customer.
So our lending book is linked to our rack rate, not the RBI repo rate.
Everything is linked to repo directly or indirectly. Because we borrow from banks, and all those loans are linked either to T-bill or to repo, whether internal or external benchmark. So indirectly or directly, everything is linked to market.
Okay. So typically when someone borrows from the bank, it's like repo rate plus some spread. So like to our customer, how do we communicate in terms of yield? In our typical agreement, how
we communicate to a customer saying that this is the rate, this is the margin. That's all.
Okay, all right. Thanks a lot.
Thank you. The next question is from the line of Chandrasekhar Sridhar from Fidelity International. Please go ahead.
Hi. Do you have any thoughts of reducing the CP book any further? And if so, is there a timeline which you could suggest? And second is, I'm just going through your asset liability statement. It seems, which you published in the annual report, beyond 2 months you seem to be running a negative ALM all the way up to 5 years. Any thoughts on how do you correct this?
No, CP, as what we are telling, CP is raised only as a cost leverage and not a source of funds. It is backed up by the undrawn bank limits are there. So it is a cost leverage concept only. And since the backed up documented bank limits are there is also a drawdown schedule as well as the due date within which we should avail. Accordingly, the funding has been planned in such a way that throughout the year, the cost of the funds remains lower. At the same time, within the due date, the bank's funds are being availed. So when all these things have been done, the ALM is always kept in mind so that whatever the mismatch is there at a particular point of time, it will cover up so that utilization of the bank borrowing, cost of the funds as well as ALM is matches and things in line with.
Sorry, I think they're actually not matches what your ALM sales statement seems to be suggesting. Because it seems like from beyond 2 months up to almost 5 years, it seems that there's a mismatch.
No, there is a mismatch is there because the housing loan collection is for a period of 15 to 20 years, whereas the bank borrowing is 7 to 10 years. There is a gap will be there, but there is also a tolerance limit will be there. It is 1-to-1 match will never come in the housing finance industry. There is a tolerance limit also will be there within which we can function. So whatever we are talking about is keeping the tolerance limit also in the mind, and accordingly we are working on that.
Thank you.
Thank you. The next question is from the line of Prateek Singhania from Sage One Investment Managers. Please go ahead.
So my question is pertaining to a scenario, say suppose economy again comes completely back on track after COVID, and say if banks which are getting much more competitive in retail, they tend to like give some leeway or reduce some filtration process in terms of evaluating the credit rating. So in that case, if we have to simultaneously review our credit rating and say if we want to give some benefit or some leeway to the borrowers, then in that case, like how our book or growth would pan out if we want to do that?
See, we have managed normal competition from banks for many years, right? What happened during COVID was abnormal competition. So because it is abnormal competition, we had to drop rates. If it was normal competition, I think it is a steady state for us, and we would very easily manage the differential and not take competition on, right? So I don't think so that situation would, because COVID was probably once in a century kind of event, and therefore we had to make this change. And in spite of making this change, you've seen that in last 6 to 8 quarters, we've done pretty well given the context of COVID. Both in terms of book retention or disbursement or NPA management, right? So if it is normal competition, there is no issue because the differential is always going to be there. If it is abnormal, let's say like COVID, then obviously we also need to change a strategy to see how best we can manage things.
So are you seeing this competitive intensity reducing from bank, like as and when we are opening?
Drastically it has come down. This is what I told. See, last year, Q1, Q2, Q3, huge competition, right? And Q4, we saw that competition was there, but it started coming down. Now, from Q1, normal business for us and normal competition, because from April, we increased rates. In spite of increasing rates, in last 4 quarters, 3 quarters have been all-time ever highest disbursements in the history.
Okay, so again, like banks would be focusing again back to more of corporate.
What actually happened was, now economic activity is improving, and obviously, SME as a segment has improved, corporate credit has kicked off, and therefore dependency on mortgage for growing bank book also has come down drastically. And therefore now there is normal competition. So we don't see too much of competition now from banks, the way we saw last year.
Okay, all right. Thank you, sir. That answers my question. Thank you.
Thank you.
Thank you. The next question is from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Yes, sir. Thank you for allowing me a follow-up question. So, 2 data keeping questions and then 1 final question. If you could just help us with the stage 2 loans number and what is the provision that you're carrying on stage 2 loans?
Okay.
You want the provisioning as per stage 2 loans is as per the India as well as IRAC norms?
Both will be.
Yes, sir. So first thing is what is the proportion of stage 2 loans right now, and what are the provisions that we are carrying on those stage 2 loans?
Stage 2 loans as of now is 427 crores. That is SMA2, what we classify as stage 2, out of the total book of 25,091 crores. So provisioning of stage 2 as per the IRAC norms, whatever we have to maintain is to the extent of around 69 crores. Whereas as per the ECL model, it comes to 45 crores.
Sure, sir. And so during your opening remarks, you also talked about the BT out numbers that you saw during the quarter. If you could just repeat that for us.
Okay, BT in Q3 was about 78 crores, which means about 26 crores every month. This number used to be 3 times higher last year, Q3.
Sir, sorry, Q2, how much was it?
No. Last year, Q3, this number was some 278 crores.
Okay. All right.
278 crores.
Got it, sir. And so then the last question that I had, thank you so much for this. The last question that I had is, there seems to be some confusion around the repricing of loans. So if I understand you correctly during the call, so if someone had taken a home loan from you at 7%, which was Q4 of last fiscal year, let's say January or February last year. This year, given that your rack rate is now 8.25%, so that 7% loan that someone took last year, in this January or February, it will get repriced to 8.25%, is it?
Yes, yes. What you said is right. It gets repriced annually. Okay. Whatever is the current rate, it gets repriced at that.
And so do you have levers to kind of make sure, because I mean, if someone sees a 125 basis points kind of an increase in home loan rates, when clearly the home loan rates of banks have not increased as much, will there be any retention policies in place which could kind of lead to a similar pressure on your yields in the coming quarters? And so lastly, given the kind of disbursements that we've seen during this year, what is it that you're targeting in terms of a disbursement growth in FY23?
Let me explain to you again on the interest rate scale. See, for example, let's say today my rate is 8.25. That's a rack rate. Okay. I have an offer where I offer 7.5%. Now the 7.5% is for 1 year. So after 1 year, the 7.5 becomes 8.25. Number one. Okay. Number two, whenever I give loan every year, so we have S1, S2, S3. S1 being the best, S3 being the worst, right? Relatively. Now, based on the change of risk rating, my rate also would change. Number three, whenever there is change in the interest rate scenario, it could be, rate could be, could increase or decrease. That I would be, if we take a call, we will be able to pass on that benefit or that increase in cost to customers. So these three are the, aspects what comes under interest rate changes. Now, your second question was?
The second question was, what is the disbursement growth that we have in mind in FY23?
Yeah. So, we will be able to grow at 18-20% both on disbursement and book.
I'm sorry, sir, can you repeat yourself once again?
18 to 20%.
Disbursement growth.
Yeah.
All right, sir. Thank you so much for your patient answering. Thank you.
Thank you.
Thank you. The next question is from the line of Nischint Chawathe from Kotak Securities. Please go ahead.
Yeah, hi. Am I audible?
Yeah, it's audible. Please carry on, sir.
So this is just a clarification. I know you touched upon this in the call, but what is the reason for increase in the NPL coverage during the quarter?
The NPA coverage is because of the aging factor as well. There is a stage movement in the NPA. Because of stage movement, it mandates the provisioning.
Within the NPA bucket, something moving from 6 months to 1 year.
Within the NPA bucket. Because when the account becomes NPA, you will provide 15%.
Yeah, got it.
Yeah, and then 50 and then eventually 100, yeah.
Sure. And just one thing on the investments that you are making, for LCR and government securities, what would be the duration of those bonds?
10 years.
10 years.
10 years. And then in that sense, assuming a scenario of rising interest rates, you would probably have to take some MTM hit as well, right?
We have that option.
We have that option, yes.
Okay. And just one last question. What are your approval rates or rejection rates, whichever way you put it?
So approval rates, we have blended, we have about 88%. Approval rate is 88%.
Okay. And is that sort of changed over time?
Yeah, during COVID time, it came down to about 84, 85, and then again now it is back to, it hovers between 88 to 90%.
Sure. And did you anywhere in the call mention that the demand for salaried loans is higher than non-salaried at this point of time?
Yes, I did mention that. Demand for salaried is quite high compared to SENP, but however, SENP has improved over last few quarters. From 30% incrementally, it has gone down to 12%, and then 15, 18, now it is back to 26%.
But is that because of tightening of screens from your side for SENP customers, or is it because the demand was lower?
We haven't done any change with respect to policy or credit underwriting or the process. It is only market dynamics.
Sure. Great. Thank you very much.
Thank you.
Thank you. The next question is from the line of Karan Agarwal from Quest Investment. Please go ahead. Karan Agarwal, your line is in talk mode. Please go ahead with your question.
Hello, am I audible?
Yes, sir.
Yeah.
Thank you for taking my question, sir. So I have two questions. One is on the competitive side, competition intensity, and the other is on the technology initiatives which Can Fin is taking. So coming to the first question, the average annual income of the customer segment which Can Fin
Sorry to
targets.
interrupt you, Mr. Agarwal. The audio is breaking from your line, so please check.
Yeah, give me a moment. Hello, am I audible now?
Yeah, please go ahead.
Yeah. So the current income of the current annual income of our target customer is 6 lakhs. Is that correct?
It's about 38 to 40,000 per month.
Yes. Yeah. And as I could recall in the previous quarter or a quarter before that, we were targeting customers who have an annual income of close to who have a monthly income of close to 1.5 lakhs. Is that correct?
No, our average income of our customers is about 38 to 40,000 per month. I also mentioned that we also focus on high value salaried case, but that's an exception.
Oh, okay. Thank you, sir. Got it. And the second question is on the technology initiatives which Can Fin Homes is taking. For example, I checked that on my Google App Store, that we don't even have a app for a customer, right? On the other hand, there are players who focus on small ticket affordable housing companies. There they have an app, and close to 70% of the customers interact through the NBFC through the app itself. So what are we doing in terms of the technology and the digital initiatives?
See, there are two aspects to this. I have seen the entire digital journey for various products in last 5 to 7 years. Right now, as a company, we focus on automation. When I say automation, we work on Perseus, then Dakota, then we will have front end. So we are working on automation, but not really on the digital journey per se, because there are certain risks associated with digital journey. I don't want to get into details in this call, but because this is not a small ticket personal loan or a personal loan, where the ticket size is lower so that we can have a digital journey. Here there are so many manual legs like legal and technical. Having said that, I think mortgage as a product would need a lot of automation, and we are working on that. And at the same time, we are also working on changing the entire IT infrastructure within. So as part of that, we will have online sourcing, tab sourcing, online collection, integration with various APIs and stuff like that.
Okay, sir. And the account aggregator framework that the government has come out, we are working to integrate that into our business as well, right?
Please come again. What was that?
So the account aggregator framework which the government, which the RBI has come up with, Can Fin is working to incorporate that into our business as well, right? For underwriting.
No, I don't think so.
That is still under study.
That is still under study. As of now, we have in-house. Everything is in-house.
Okay, sir. Got it.
And we don't plan to outsource unless there is a regulation on this.
Okay, thank you.
Thank you. The next question is from the line of Pooja Ahuja from Monarch Network Capital. Please go ahead.
Yeah, hi sir, thank you for the opportunity. So firstly, I wanted to understand on the credit cost, on a sustainable basis for the next 2-3 years, how much credit cost can we expect?
I don't think so. There'll be too much of change in the credit cost, because we believe that we'll be able to maintain NPA less than 1%. And today it is 0.71. So we don't expect too much of credit cost. And we also have planned to work on the NPA pool, on the restructured pool. So you will not see too much of a difference in credit cost.
Versus, let's say, the pre-COVID level? Is that what we're estimating?
Pre-COVID level. Yeah, it will be in that level.
Okay, sure. And secondly, the two levers that the real estate sector as a whole was seeing in terms of, stable home prices and low interest rates, how do you see the impact of these two levers sort of increasing, seeing an incremental trend that can probably impact demand, if at all?
So I think we are already reaping the benefit changes. Okay,
right.
affordability is very high, and real estate prices have actually eased off, and the demand is quite robust. So this will definitely help the industry and also us as a company, at least for the next 4 to 5 years. The only thing which might change is that probably increase in interest rates. I think I mentioned that we'll be able to absorb that up to 125 to 150 bits.
Okay, sure, sir. And just one data keeping question. So what was the BT out number in the last quarter? And let's say pre-COVID?
Quarter 2 was 70 crores. Quarter 2.
Okay, and maybe let's say in Q3 FY20?
I am expecting maximum 30 crores per month.
Okay. Okay. Sure, sir. That's it from mine. Thank you.
Sure.
Thank you. The next question is from the line of Gaurav Chan from Centrum Broking. Please go ahead.
Yeah. Thank you for taking my question, sir. Am I audible?
Yeah, please go ahead.
Yeah. So firstly, just a color on the disbursements. So, in terms of Q4, given the backdrop of the third wave, how should we look at disbursements for quarter 4 also, including January?
I think typically quarter 4 should show improvement over quarter 3, assuming that Omicron will not aggravate.
Okay, so it could be higher than the 2,500 of the crore that we have clocked this quarter.
Yeah, if Omicron eases from now, I think quarter 4 should see much higher disbursement compared to quarter 3.
Sure. So just an extension of the previous question in terms of borrowing mix. So in the near term, I mean next quarter or 2 quarters, how should we look at the borrowing mix? Could it be at similar levels that we saw in Q3?
I think there won't be much change in the borrowing mix. It all depends because nothing. I think borrowing mix will not change, quarter to quarter. It takes about 3 to 4 quarters for meaningful change in the composition. Bank would still be close to 50% of the total mix. We can see a bit of increase in NCD because every incremental sourcing requires 25% of NCD. So NCD you can see slightly inching up. And I think rest would still remain the same, not much of change.
So could you quantify the borrowing number for the quarter, please?
Sorry, come again?
Borrowing number for the quarter.
For the quarter.
Incremental borrowing for the quarter. You are talking about Q3?
Yeah, Q3 closing figure for borrowings.
Closing figure for borrowing is 23,550. The book. Borrowing book is 23,550.
Okay, sure. Thanks. Just one last question, sir. A clarification on the provisioning bit. So conceptually speaking, the provision on the restructured and X of restructured standard asset provision would be under the same head, right?
Anand, your voice is breaking.
Sorry, if you could please repeat the question.
Yeah, just a minute, sir. Just a minute. So what I'm asking is it better now, the voice?
Yeah, now it's better.
Yeah, what I was asking is in terms of the provision on the restructured and the provision that says X of restructuring, that would be under the same head, right?
That will be under the same head, yes.
Okay. And could you quantify the restructured book in the current quarter, please? Last time I think we had quantified a number of
total resolution 2 was 650 crores, resolution 1 was 77 crores. Both put together, today the outstanding is 711 crores and 20 crores of the book has been repaid.
So 711 minus 20 is the number that we have to look at, right?
Yeah, 690. 690 is the book outstanding as of 31st of December.
Okay, got that, sir. That is it from mine. Thank you so much.
Thank you. The next question is from the line of Rahul from Multi-Act. Please go ahead.
Yeah, thanks for the opportunity. Sir, just wanted to reconfirm again. You said that you made 40 basis point of provision on standard assets. Is that correct?
0.45.
0.45. Okay, but when I look at the provision number for this quarter and divided by the increase in loan book, I get a slightly higher percentage. So can you just explain?
No, this 10.97 crores, which is standard asset. So this is restructuring is some bit, and the balance is for increase in incremental book.
Okay. Okay. So on a going forward basis, we should expect 45 basis
So, for
points.
example, from next quarter onwards, you won't have anything on restructuring. It will be only standard asset provisioning on book increase and NPA.
Okay. Got it.
Yeah.
Thanks.
Thank you. The next question is from the line of Dhruvesh from Mirabilis Investments. Please go ahead.
Yeah, hi. So, in last quarter, you talked about raising some 750 odd crores of NCDs, and I think we have raised some 275 crores in November. So, wanted to know the rate of the same, and when do we expect the remainder to be raised, like the time frame?
275 crores raised at around 6.10% for 39 months. And remaining we have to raise in this quarter. We are already tied up with a couple of investors. It is only the rate. They were all waiting for the Q3 result to be out to finalize the thing. Probably in next 2 months we are going to raise the balance amount.
Okay, and the rate, can you repeat, like to 275?
6.10%, 39 months is what we raised last. That is 275 crores.
Okay, okay. And so this was because like the 750 was because we were going to mature certain NCDs. Is that correct, right? So wanted to.
No, it is not matching of one-to-one assets. No NCDs were matured during this quarter.
No, I mean, I think there was some maturity in the quarter 2 or quarter 1. So.
Yeah, quarter 1 it was there. Quarter 1 there is a maturity of NCD. This what we raised is to the purpose of incremental borrowings. We have raised 25% from NCD as per the SEBI guidelines. This is one step towards that aspect.
Okay, so what was the amount which got matured in quarter 1 and the rate?
What is matured? You are talking about what is the matured? Matured one is somewhere around 260 crores asset. What is matured? And the rate, because it has been raised around 3 years back, the rate was somewhere around 7+.
Okay, okay, got it. And with this, like you said, the remainder 475 is expected in the next 2 months, sorry. So can we expect the CP to go down? I mean, I understand the CP is for the undrawn and not for sourcing. But since you said the long-term rate is lower than the CP, so do we expect the CP percentage to go down since we plan to raise the remaining 475 in the next 2 months?
No, see, I'll tell you, because the CP is used for cost leverage. It is not for funding purpose. So if you see an opportunity where we can try and bring down cost, we might use CP as a channel. So all I could say is that the CP will be raised only against only as a backup, only if you have undrawn term loan limits or undrawn OD-CC limits.
Okay, got it. And my second question is with respect to the COVID buffer. So if I recall the number correctly, it is some 33 crores, right? So like what is our stance on the reversal of the same or utilization, since like the NPAs are controlled and even the stage 2 is quite controlled? So
from this quarter note, we are on standalone basis. Whatever COVID excess provisioning we have, we have utilized that.
Okay, okay, got it. Thanks, yeah.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Mr. Girish Kousgi for closing comments.
Thank you so much. I think market is quite good. And as I mentioned that I think we are on the growth path. Disbursement, there is an increasing trend. Book is increasing. Margins are improving quarter on quarter. And even NPA is under control. Not just NPA, the entire SMA and the asset quality per se is pretty good. The collection efficiency is back to pre-COVID levels. And hopefully we should be able to show up this performance in the coming quarter. As I mentioned, in the coming quarter, we can see for the whole year there will be some kind of increase in the PAT, but revenue would still be flat. I think starting from first quarter of next year, I think we'll be pre-COVID levels. The only change being aggressive on growth in terms of disbursements and book. Thank you very much.
Thank you. Ladies and gentlemen, on behalf of Investec Capital Services, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.